Good morning, everyone, and thank you for joining us for Toku's first earnings presentation as a listed company. My name is Nora, and I'll be your host and moderator for this session. With me today, I have Thomas Laboule, our CEO and founder, and Christian Wong, our Chief Financial Officer, who will walk you through the group's financial results for the year ended 2025. Welcome, gentlemen.
Good morning, Nora.
Good morning, Nora.
Throughout the duration of this webcast, you will see a QR code at the bottom of your screen and also a link in the live chat for you to send in your questions. Feel free to submit them at any time and we'll address them after the presentation. So without further ado, let me hand over the reins to our CEO, Thomas. Thomas?
Thank you, Nora, and good morning to everyone joining us today. Welcome to Toku's inaugural earnings call. This is a milestone moment for the company, and we appreciate very much that you are taking the time to be here with us today. As you know, Toku listed on the SGX a little over a month ago. On the 22nd of January of this year, we did our IPO on the Catalyst. Today, Christian and I will take you through our FY2025 performance, share the context on the underlying business trajectory, and give you a sense of how we see the year ahead. Before we begin, I would like to draw your attention to the important notice on the next slide. As expected, this presentation will contain forward-looking statements that are subject to the usual risks and uncertainties. The financial information we discuss today is also unaudited. For the full details, I encourage you to read our SGX announcement published yesterday alongside this presentation. We will now move on to the substance. First, the agenda. Let me give you a quick roadmap for our discussion. We will start with the key highlights of FY2025. Then Christian will walk you through the revenue performance, profitability, and cost discipline in more detail. We will cover the balance sheet transformation that took place around our listing, our cash flow position, and how we are deploying the IPO proceeds. I will then share some leading commercial indicators from last year that give us confidence in the trajectory ahead, before wrapping up with our strategic priorities for 2026. Last but not least, all the numbers we are presenting are in US dollars, unless stated otherwise. Let's get into the key highlights for last year. The headline picture for FY2025 is that despite navigating a challenging year, we were able to deliver growth with operational discipline. And I want to set the tone early because the reported numbers include a significant amount of non-cash and non-recurring charges related to our IPO process, which can obscure what is actually happening in the underlying business. Our total revenue grew 9.3% to $34.8 million. The usage revenue, our largest stream, accelerated by 21%, reaching $23.9 million. On an adjusted basis, stripping out the IPO-related charges, our EBITDA improved by nearly 18%, our strongest full-year EBITDA performance to date. The underlying operating expenses actually declined 7.5%, even while the revenue was growing, and the adjusted net loss narrowed by 8.5%. The cash on hand increased to $2 million at year end, and this is of course before the IPO proceeds came in. Christian, over to you.
Thank you, Thomas. Just to reinforce the point that Thomas made just now, the reported numbers included approximately $4.9 million of extraordinary items, net of offsets that are directly attributable to the IPO, of which $3 million in accelerated share-based payment charges, $400,000 in fair value adjustments on the convertible instruments. None of these will recur in 2026. There were another $2.3 million in listing costs that were incurred as of 31st December 2025. These are partially offset by a non-recurring tax credit of $800,000. When you look past those items, the underlying business is clearly moving in the right direction. Let me take you through our revenue in more detail. Total revenue increased 9.3% to $34.8 million. This is driven primarily by strong performance in usage, which grew 21%. And which now represents close to 69% of our revenue mix. That growth in usage reflects three factors. First, the launch of our Latin American operations, which we completed in the first half of 2025, the expanded traffic volumes from existing APAC customers, and the early stage contributions from new deployments. We also began monetizing our AI-powered capabilities during the year, with the core AI suite gaining adoption, though the revenue contribution there was not yet material. Subscription and licensing edged higher at 5.6 million in the year. Professional services declined 25.6% to 2.4 million, and maintenance and support was down 12.2% to 2.6 million. Both of these declines are well understood. Professional services was impacted by the workforce restructuring exercise that we completed in the second half of 2024, and by the delayed project commencements, while the maintenance and support stream saw certain legacy contracts reaching completion. Importantly, we expect both of these streams to recover. The delivery team has since stabilized, utilization rates have improved, and the project pipeline is converting. As our channel partner program develops, partner-delivered services will also complement our direct delivery capacity. On gross profit, we came in at 8.4 million for the year, a modest 3.1% decline year-on-year. The gross margin compressed from 27.4% to 24.3%. Now, this is an important slide because I want to make sure that the margin story is well understood here. The compression is a direct consequence of the revenue mix. Usage, which carries a lower gross margin than our software and services streams, grew 21% year-on-year and increased its share of total revenue from 62% to 69%. That mechanical shift compressed the blended margin, even though the total revenue grew. It was amplified by the reduced contribution from our higher margin streams of professional services and maintenance and support. We see this compression of gross margin as a temporary dynamic and not a structural one, and we have identified clear levers for margin recovery.
Exactly. And this is consistent with what we disclosed in our offer document as well. As an integrated platform, our blended margins will naturally reflect the mix between connectivity, software, and services. But the direction of travel is towards higher margin revenue. The way we intend to achieve this is by, first, the growing adoption of AI-enhanced services, which carry a higher margin profile. Second, our channel partner program, which enables scale without proportional cost increases. Third, the platform maturity, where proprietary technology progressively replaces some of the third-party components we've been using. And fourth, the broader rebalancing of our revenue mix towards subscriptions and licensing over time.
This slide brings together two adjusted profitability measures that we consider most representative of underlying performance. On the left, you have the adjusted EBITDA reconciliation, where you can see the reported EBITDA loss was 8.5 million. Adding back 3 million in share-based charges and the 2.3 million in listing costs, we arrive at an adjusted EBITDA loss of 3.3 million versus 4 million loss in 2024, which represents a 17.8% improvement year-on-year. The adjusted EBITDA margin improved 3.2 percentage points from negative 12.6 to negative 9.4%. On the right side, the adjusted net loss reconciliation follows a similar pattern. The reported net loss of 9.1 million includes approximately 4.9 million of non-cash and non-recurring items on a net basis, which includes share-based charges, fair value adjustments, and listing costs, that I just described, partially offset by the 800,000 of tax credit. When we strip all of that out, the adjusted net loss shows an improvement of 8.5% year-on-year to 4.2 million, with the margin improving 2.4 percentage points. The message here is clear. The underlying business is generating improving returns, and the IPO-related charges are behind us. The cost discipline story is one that I'm particularly pleased with. Underlying operating expenses, excluding non-cash and non-recurring items, declined 7.5% to 11.8 million, despite a 9.3% revenue growth. The OPEX to revenue ratio improved from 40.1% to 33.9%, a reduction of 6.2 percentage points. This is meaningful operating leverage. The largest contributor was headcount cost, which fell 7.6% following the restructuring exercise held in the second half of 2024. Office costs declined 64.8% with a shift to the hybrid working model. Professional fees declined 10.2%, though I should point out here that we expect some normalization in 2026 as we absorb the full cost of operating as a listed entity. In a broader sense, we do anticipate a step up in certain recurring costs in 2026, particularly around compliance, professional fees, and marketing as we invest in broader brand awareness and meet our listed company obligations. The important point here is that the structural efficiency gains, especially the shift towards channel partner-led distribution, are designed to support revenue growth without proportional headcount increases. This is our long-term operating leverage thesis.
And what I find encouraging about these numbers is that they validate the decisions we made in late 2024. The restructuring was not easy, but it was the right call. We reshaped the team around the capabilities we needed for the next phase: AI, platform development, and channel enablement. The result is a leaner, AI-enabled organization that can grow revenue without growing costs at the same pace. And as Christian mentioned, the channel partner model is central to this. By empowering partners to sell and deliver our solutions, we extend our reach into markets and customer segments that would otherwise require significant direct investment.
This is a critical slide to understand because the balance sheet at 31st December 2025 looks very different from where we stand today. Total assets grew 7% to 16.1 million. Total liabilities increased to 21.1 million, but that increase is substantially attributable to the recognition of 7.1 million in financial liabilities at fair value, which represents the pre-IPO convertible loans. Per SFRS accounting standards, these instruments were classified as liabilities rather than equity, even though they were always intended to be converted into shares. As a result, total equity at year end was negative 4.9 million. I want to be very direct about this. That negative equity position is substantially a consequence of non-cash items and accounting classification that have since been resolved. On the right-hand side of the slide, you can see the timeline of events that have materially transformed our capital structure post-year end. On the 13th of January, the convertible loans were converted into equity, eliminating 7.1 million FVPL liability. On the 22nd of January, we listed and raised 16.25 million Singapore dollars in gross proceeds. On the 28th of January, we paid all of our shareholders' loans in full. And the venture debt facility with Iris Fund is scheduled for early repayment on 9th of April, which will retire our highest cost borrowing facility. We're concurrently evaluating replacement financing on more favorable terms. So following these 2026 transactions again, the balance sheet today is fundamentally different from what you see as at 31st of December 2025.
I think the key message for our shareholders is that the capital restructuring is largely complete. The pre-IPO instruments have been converted, the shareholder loans are settled, and the venture debt is going to be retired. We're therefore now operating with a clean post-IPO capital structure that supports our growth ambitions.
On cash flow, net cash used in operating activities was negative 4 million compared to negative 3.8 million in prior year. The slight increase in the outflow of 200,000 was mainly due to improved net working capital of positive 1.5 million, but this was also offset by the incremental IPO costs incurred in the second half of 2025. Investing outflows was negative 1.7 million, down from negative 2.2 million. The main item here was $1.1 million spent in platform and module development, which is our continued investment in expanding our CX platform, including our AI capabilities. Financing activities generated 6.9 million, principally from the pre-IPO convertible loan proceeds of 6.7 million. Cash at year end was 2 million, up from 0.8 million, which has been significantly strengthened post-year end by the IPO proceeds. We raised gross proceeds of 16.25 million Singapore dollars from the IPO. Here's how those funds are allocated. The largest single allocation, 4.6 million, is for strategic M&A and general corporate purposes. Platform expansion and technology were allocated 3.9 million for continued R&D investment, talent acquisition, and channel partner ecosystem development. We have also set aside 2 million as cash reserve to strengthen our liquidity. The shareholders' loan repayment of 2.3 million allocated has since been completed. We eventually used 2.95 million with a small surplus retained as working capital. And listing expenses were allocated 2.5 million, of which about 1.1 has been settled to date. In total, 4 million Singapore dollars have been utilized so far, with another 12.2 million remaining. The utilization to date is in accordance with the stated purposes in our offer document.
The important takeaway here is that we have the capital to execute on our strategy. The proceeds are earmarked for growth, and we will update shareholders on further utilization through the regular SGXNet announcements as those funds are being deployed. Let's move to the commercial momentum. And this is the slide I'm most excited to share because it tells a story that the financial statements cannot fully capture. Our industry runs on long sales cycles. When we win a deal today, it can take several quarters before it starts contributing to the revenue. So what you see in the FY2025 financials largely reflects commercial activity from 2024. The work our sales team completed last year is still converting into deployments and revenue. With that in mind, let me share the leading indicators. First, we are winning bigger. The new business deal value grew 12% year on year, and average deal sizes are now 1.6 times what they were in FY2024. We are also landing at scale. New customers are arriving with real commitment. Nearly 17% of our top 30 revenue contributors are scheduled from new logos we signed during the last 12 months. And we are converting more efficiently. Our close-won rate improved from 6.4% to 9.4%. That tells us that we are qualifying better and competing where we have a genuine edge. Especially our tender processes have scored very well, with a win rate that is now almost 24%. Our customer base is shifting up markets, as aligned with our strategy. With Tier 1 and Tier 2 customers, those above $200,000 annually, growing 8% last year. That resulted in a healthier, more concentrated portfolio. And the AI demand is accelerating. Customers are increasingly expecting AI capabilities as part of the solution, and the requests are more and more complex. We closed our first AI contracts with both enterprise and government sector customers during the last 12 months. Putting all together, those indicators tell us the commercial engine is strong and the financial results will follow. Looking ahead to FY2026 and beyond, our priorities are clear. First, AI monetization at scale. We are moving the core AI suite in our agentic AI program from early deployments and monetization into broader production use. This is about driving adoption across our existing customer base and ensuring that AI-driven usage becomes a meaningful contributor to revenue and margins. Second, the channel partner development. We are building a partner-led distribution model that complements our direct sales. This is the key to scaling efficiently across our now 38-country footprint without needing to grow headcount proportionally. Third, the geographic expansion. We will continue to deepen our penetration in APAC, LATAM, and MENA, while building on our early European market presence we announced a couple of weeks ago. And fourth, strategic acquisitions. We have capital allocated from the IPO proceeds, and we are actively evaluating opportunities that can accelerate our growth and expand our platform capabilities. On the right side of this slide, you will see the key factors that may influence our performance over the next 12 months. These range from the pace of AI adoption to macroeconomic conditions in our principal markets. We outlined these transparently in our announcement and previously in the offer document. Before we open for questions, I want to leave you with the investment thesis in summary. We have a proven growth engine. Even in a challenging year, we delivered 9.3% revenue growth on top of the 47% compounded annual growth rate from the past period. Second, we are building an AI-first platform with proprietary multilingual capabilities and an advancing agentic AI program. Our complex market mode, now spanning almost 40 countries, creates a genuine barrier to entry for competitors that are struggling where we are winning. We made a competitive advantage of the fragmentation in regulatory and operational environments. And that's what we will continue to focus on. And we are also mindful of profitability. With adjusted EBITDA improving 18%, an OPEX to revenue ratio below 34%, and multiple identified levers for margin expansion, we are very confident in the foundation that we've built and the trajectory ahead. Thank you for your attention.
Thank you, Thomas. Thank you, Thomas and Christian. We will now take a short break, after which we will take your questions. Please send your questions in via the QR code or link in the chat if you haven't done so in the meantime.
We've all been there. Stuck, frustrated, wondering why something so simple has to be so hard.
Huh?
It happens, sometimes more often than it should.
Please provide the last 4 digits of your NRI. Sorry, that number is not recognized. Please try again. Please hold while we connect you to an agent.
Good afternoon.
Hello?
How can I help you today?
I just got an SMS saying that there's a transaction to my card.
For which account?
我刚损失了$10,000,000，我现在该怎么办呢？
I'm so sorry, I don't understand Mandarin. Could you repeat that in English?
Talk to your supervisor, please.
In an increasingly global world, communication brings new challenges, but that shouldn't stop us. For enterprises, turning complexity into seamless customer experiences is what matters most. When focus shifts to outcomes, transformation begins. Built for the world's most complex markets, Toku is the AI-powered CX platform that provides the context that matters,
这笔交易我看到了，我们可以把它撤销。
turning insights into action.
You're welcome. Thank you for calling customers.
Every customer journey becomes personal and purposeful. Customers feel understood. Teams are empowered, and businesses make an impact. At global scale, connection is shaped by language, culture, and context. It demands more than reach. It demands understanding. AI-powered customer experience forged in Asia's complexity, ready for the world. Toku, reimagining customer experience for enterprises at scale.
All right, so thank you for submitting your questions. I'm sure you have had quite a lot to digest over the past few minutes. I have received quite a few here, and I just wanted to say that there were quite a few that actually asked questions that we cannot answer by regulations. Things like forward-looking statements and projections we are unable to disclose. So just bear in mind that if we don't address those questions, that's the reason why. So I have here the first question that I want to ask. I think this would go to either Thomas first. Is the revenue growth rate of 9%-ish standard? And will we expect this similar growth rate in the future?
Look, 9% for 2025, which was a challenging year, is actually a good result, right? We basically were managing the reorganization that we did at the end of 2024. At the same time, also the whole process of the listing. Anyone that went through an IPO knows how distracting it can be for an organization, and we took that head on with the entire management team. And let's not forget that we also were able at the same time to expand, actually double our footprint over the last 18 months, since we are now 34 countries in 2025, but we already announced earlier this year that we are now in also 4 countries in Europe. So that expansion combined with all the activities that we were doing, I think that 9% growth is showing how resilient the growth engine of Toku is. And moving forward, actually everything that we've done is a transformation, and we are seeing that as a way to unlock the next phase of growth of the company.
Very clear. Okay. So the next question goes to, I think this one Christian would be able to address. The USD is trending downwards and Toku deals in USD. So how would that affect Toku's finances moving forward?
Sure, thanks, Nora. We currently have a natural hedge in place where most of our revenues and cost of sales are denominated in US dollars, right? But also, just to remind everyone, we just raised $16.25 million in Singapore dollars, which is doing much better than the US dollars at the moment. So I think we're covered for now.
Okay, that's great news. We have, another one just came in. What will be the biggest revenue driver for FY 2026? And is Toku factoring in higher infrastructure costs for FY 2026 with the AI drive?
Very interesting question. Look, I think that first of all, in terms of the revenue drivers, let's not forget that we have the advantage of having built an integrated platform, which means that for us, every new customer is typically going to contribute to every revenue stream. Of course, in the life cycles of our customers, we have different streams that will arrive either in sequence or will then be simultaneous later on. I'm particularly thinking of the usage portion and the licensing part that typically comes after the initial services portion of the revenue stream. Overall, what we have seen in our pipeline and also indicated in the commercial slide from just now is that we are having access to bigger contracts than before. It's actually been a trend throughout the journey of Toku that every year we were able to access bigger contract sizes. And that is something that we see as accelerating actually because of the brand awareness that we gained over the last few months and also the experience of the team. All of that is also linked to what we've seen in the international expansion itself, right? The fact that the complex and regulatory challenging environments are actually demanding and seeking solutions like ours that are adapted to it is something that we are all very excited about and I think is going to be driving the year ahead.
Okay. That's a very complex question and a very complex answer as well. Okay, so the next one that I would like to ask would go to Christian. And this is, can you explain the negative equity position?
Sure. As we explained just a few minutes ago, we had a capital deficit on our balance sheet as of year-end 2025. Right? There were two main reasons. One was because of the convertible loans that amounted to 7.1 million on the balance sheet. Right? Also, we had some IPO related charges that happened in 2025, right? But I also want to remind everyone that those same convertible loans have been converted into shares just in January of this year. Also, we've raised 16.25 million Singapore dollars or 12 million plus US dollars in new shares, which immediately improves our capital structure today. Yeah.
Thank you. All right, so this one is a big question. Let me just try and break it down for you, okay? So it's a few questions sent by a single audience member. Could you elaborate on the recent big contract wins, clients and size, and their impact on 2026 results? Let's just start with that one first.
Look, in terms of elaborating, I think that I want to reiterate what I said just now, right? The fact that we are seeing bigger contracts is actually something that is following a trend. It's partially intentional as well because we have been strategically focusing on larger deals. That's why we are also very happy that the tender rate win actually increased last year as shown in the commercial indicators because it means we are also getting better at articulating what we are offering and proposing solutions to these more complex requirements and winning the deals with our solution and our technology. So moving forward, we see that as something that we want to accelerate and repeat more often. That's actually also how we were able to win these deals in different regions, is that there is a notion of repeatability there because some of the problems that we are basically solving now, not only in Latin America, but also in MENA and upcoming in Europe, are things that we already solved in Asia Pacific. And therefore, with that track record, that expertise, we were able to convince the prospect and convert them into customers. So as I mentioned during the presentation just now, what we want to do is to increase the average revenue size per year per account and continue to do that for the years to come as we also access larger opportunities.
Sounds good. It's also reflective of the longer sales cycle that comes with such big contracts as well. What visibility do you have on the revenues from these contracts? Can you see them from 6 to 12 months?
So without providing a forward-looking target, obviously our ambition as a company is to continue our growth every year, as we've done since the inception of the company. We've had 8 years of successive growth. Every annual result has been higher than the previous one, and we are now seeing an opportunity to unlock a further acceleration, which is basically done through the whole transformation that we described earlier. So moving forward, obviously we are working on growing the company and growing therefore the top line as well as the profitability.
Okay, I think that kind of addresses the following on any guidance on the 2026 revenues. We can't really share that much information for the future, but
I can share the ambition of the company.
Yeah,
the ambition of the company is to grow while also continuing to improve the operational excellence and therefore moving towards the profitability. And I think that exercise is actually what we are constantly balancing as a management team together with Christian and the rest of the senior leadership, is to figure out how to access all the growth that we are unlocking without at the same time increasing or expenditure too much, right? And that's a balance that so far we've been able to achieve, and we are actually seeing 2026 and beyond as the opportunity to continue that journey.
Yeah, for sure. All right. We have one that's kind of a follow-up question from what was asked before. Are you expecting higher infrastructure costs for this year, given the AI drive?
Well, there are two things working at the same time, and Christian can definitely talk a little bit more about that in a second. But our AI innovation is also happening at the same time that we have a scale advantage, right? And actually last year, Christian, we were able to renegotiate with one of our hyperscaler partners in terms of the infrastructure, and therefore we are accessing now better rates for a lot of what we are doing. And we've also been improving the technology itself, right? So I think that amongst the entire transformation of the last 18 months was also the move to the third version of our platform, which is much more efficient on a lot of aspects, and that includes also the cost. So we do not expect a massive increase in infrastructure cost, because let's also not forget that we've implemented a lot of these investments when we entered Latin America as well as MENA. So a lot of that infrastructure is already in place and can accommodate more than one or two or three customers, right? Obviously, we can accommodate several customers on the same infrastructure before we even need to expand it.
Okay, thank you. And what can shareholders expect in the year ahead?
Well, a lot of good things. First of all, what we see is the continuity of our expansion in the AI portion. So we have an entire ecosystem. That integrated platform, I think, is very often underestimated as about how much of an advantage it is, right? AI is a revolutionary technology. We've all seen it. We use it in the company as well. The different teams are gaining in productivity, and it was part of the entire reorganization as well. As we are building AI for our customers, we also have to be a fully AI-enabled company. So that's part of how we actually achieved that operational discipline and excellence last year. And so moving forward for us, we see really that AI is a value added to the entire ecosystem. Right? It's not just a feature or just a product, but it's also not our entire business. I think that the entire business of Toku is to help with the customer experience of our customers. So that their mission-critical communications, for example, is something that is going to be improved through the AI layer that we are basically putting on top. And so on that front, we see that our first enterprise customers or first government customers are also going live with their AI contracts that we won last year. So that is something that is very exciting and that I trust we will be able to share more about in the future, especially as we are planning some joint marketing activities with these customers.
Perfect. Thank you very much. We have quite a lot of questions, but we've actually run out of time today. Not to worry though, please reach out to either investor.relations@toku.co if you have any questions, or our media team if you're a member of the media, and we'll be able to follow up with you with the answer. Right, so thank you very much again, Thomas and Christian, for walking us through our performance from last year. It's been a great time going through this first earnings briefing together as a team.
Indeed, quite an event, and I want to thank the audience as well. And look, we always welcome additional questions and interactions with shareholders, analysts. So if there is anything that you want to know, please reach out, and we will cover that with you.
All right. So thank you very much for joining us today, and have a great day ahead.
Thank you.